Hello and welcome. Today I'm revealing 5 crypto trading strategies to take advantage of the volatile nature of those markets. We'll cover a breakout strategy, a scalping one, a momentum technique, one fading strategy, and a reversal strategy. So if you could, like, subscribe to the channel, and stick around for the full video. First crypto trading strategy is a breakout one. With breakout strategies, you can identify when the price clears a specified level. The aim is to find key levels and to take a long position if the price moves above resistance and to enter a short position when the price breaks below support. Usually, volatility tends to increase after price trades beyond the key price barrier. Prices also trend in the direction of the breakout. We'll use the True Strength Index, which is an indicator that captures the flow of price action and filters out the noise. TSI fluctuates between positive and negative, and the center line of the indicator defines the overall bias. To find the high probability breakouts, we'll focus on the direction of the future trend by analyzing the center line crossovers. A signal to buy is generated when the TSI crosses above zero. A signal to sell is generated when the TSI crosses below zero. With breakout trades, the goal is to enter the market right when the price makes a breakout and to continue to ride the trade until volatility dies down. That's why we use the True Strength Index, because it incorporates volatility in its calculation. The goal here is to use the volatility to our advantage. We'll search for breakouts and we'll confirm them with the bullish or bearish momentum indicated by the True Strength Index. The trade plan is to buy a resistance breakout when the TSI is positive and to sell a support breakout when the TSI is negative. Here we have an example of an upside breakout. First, we identify the resistance at this level. As price broke through this area, the True Strength Index became positive and confirmed the move. The breakout also occurs in the direction of the initial trend, and this is the exact type of breakout you should be searching for. This type of breakout can be found during trends. After a trend leg, price often spends some time ranging and consolidating before continuing the trend. Such periods offer great re-entry opportunities if you confirm them with the TSI. Here, this level first acts as a support and then it acts as a resistance once broken. The TSI line follows the price action on the chart. When price came back to the resistance and rejected the level, the True Strength indicated a bearish momentum the whole time, confirming our short bias. In this other example, we have a long entry near a key support level. As the price retraces to that area, and the True Strength Index is above zero, indicating a strong bullish momentum. And here we have another entry, following the same pattern. TSI is a great oscillator to trade crypto breakouts because it identifies both the trend direction and the strength of the trend. Second strategy is a scalping one, using the Smooth Heikin-Ashi. The Smooth Heikin-Ashi is a modified version of the regular Heikin-Ashi candlestick chart. The indicator is used as an overlay on the regular candlestick chart, just like a moving average. Price is in an uptrend when the Smooth Heikin-Ashi indicator is bullish or green, and in a downtrend when the indicator is bearish or red. Smooth Heikin-Ashi is a trend-following indicator. During short-term uptrends, price tends to stay above it. In downtrends, price typically stays below the indicator. The first possibility of a change in direction is when price crosses through the indicator. Downtrends start to reverse when prices cross back up and through the Smooth Heikin-Ashi, while uptrends show signs of reversal when price falls through the Smooth Heikin-Ashi below it. You can use a 10 look-back period to be on the right side of the minor market trend. When prices are trending higher, the Smooth Heikin-Ashi will adjust by also moving higher to reflect the increasing prices. The opposite would be true when price is trading below the indicator, where you would then look for selling opportunities. Being a scalping setup, to increase the probability, I like to use a price action entry, the good old simple trendline breakout. When price breaks a downward trendline and the Heikin Ashi indicator turns green and price moves above it, you get a chance to enter long. When price breaks an upward trendline, the Heikin Ashi indicator turns red and price moves below it, you look to short the market. Here, price moved through this trend line, while the drop below the trend line would likely be the first signal of a reversal in the short-term trend. It's important to pay attention to the Heikin Ashi indicator to confirm the movement. The indicator turned red and price moved below it, so this was a good scalping opportunity. The momentum strategy revolves around trading strong price moves in the direction of the main trend, using a price action ABC pattern and the MACD histogram. I've talked about this strategy a few months ago. The principle for this strategy is simple. In order for a trend to remain active, each successive impulsive swing must take out the previous swing. In an uptrend, for example, price will often make 3 points. Point A is the lowest low point, forming a support level. Point B will be the highest point, forming a resistance level. Point C will be the second low point, a support level, which must be higher than point A. The breakout of price above point B signals the continuation of the uptrend with bullish momentum. The entry is simple. You buy the breakout of the point B only if the MACD histogram remains positive during the formation of the third point, point C. So MACD histogram shouldn't go below the zero level. Here's an example. We found point A, and the first movement higher is point B. This is followed by a retracement that creates a higher low and point C. Remember, point C must be higher than point A. We analyze the MACD. If it remains positive, we wait for price to take out the recent high of point B. As MACD didn't go below the zero level, it's positive momentum. And when price breaks point B, then we can safely enter the trade, taking advantage of the upward momentum. You can also filter signals using a moving average. We have a downtrend with price below the 200 EMA, so we target a short entry in the direction of the main trend. Point A is the highest point when price finds resistance. Point B becomes a lower low point and forms a support level. Price retraced and forms a lower resistance, point C. Remember that point C must be lower than point A. When you spot the ABC pattern, you look for the momentum condition. During the formation of the third point, point C, the MACD histogram remains negative, below zero line, so negative momentum. The price breakout below point B support level indicates that the market is most likely to continue going down. Fading is an extremely rewarding strategy to profit from the novice traders that enter the market at wrong prices. The aim is to find areas where traders are trapped in the market. More specifically, I look for bear traps. A bear trap appears when the market is apparently going down, only to have the price reverse and shoot higher. This counter move produces a trap and often leads to sharp rallies. We'll use the 50 simple moving average for fading the move. Here's how it works. First, you need to identify a move coming into support, but in an uptrend. So look for the price to make higher highs and higher lows, and search for periods of corrections. You look for a breakout below support to trap the novice breakout traders. Then, you look for a strong bullish move inside the support level. You will use the 50 simple moving average as the final confirmation that the bears are trapped and long trades are on the cards. So in short, you wait the price to close above the 50 simple moving average after a clear breakout to the downside in an uptrend. We have an uptrend, with the price consolidating in a range. The price broke the support and immediately retraced within the consolidation area. At this point, you only need the price to close above the 50 simple moving average and go long. The price took off, leaving the trapped traders with short positions below the 50 simple moving average. The same pattern here, higher highs and higher lows, and the price made a downward breakout against the trend. When you fade the market, you have only one scenario in your head to go long, so you wait for price action to confirm or invalidate the bear trap. The wick of this candle is the first clue that the market has upward plans. Once the price closed above the 50 simple moving average, you have the uptrend on your side, and a lot of traders trapped on the short side, eager to get off their losing positions. Reversal trading is a more advanced strategy, and it requires extensive market knowledge and experience. In this strategy, you anticipate pullbacks and try to predict their strength using the money flow index. The indicator uses price and volume and the concept of accumulation and distribution, being quite helpful in confirming trends in prices and warning of potential reversals in prices. Crypto traders that use volume in their analysis often look for divergences between volume and price. If volume is trending one way while price is trending in the opposite direction, it could be a leading indication of an upcoming change in the direction of the market. For example, if the price is making new highs and the money flow fails to make new highs or decreases, this is a bearish divergence and can be used as a sell signal. If the price makes new lows, but the money flow fails to set new lows or rises, this would be a bullish divergence. And since the money flow integrates volume data into it, a divergence between the direction of the indicator and the price could be a leading signal. So we look for bullish and bearish divergences between price and indicator. We'll enter with the reliable price action signal, the trendline breakout. Here's an example. The money flow index reached an overbought area. We have a divergence between the MFI and the price. Also, look at the location of the divergence, where it has formed, at an area of resistance. And the sell signal was confirmed after the trend line was broken to the downside. The same setup here. The MFI reached an oversold area. We have a divergence between the MFI and the price, which was formed at an area of support, and the buy signal was confirmed after the trend line was broken to the upside. It's a more advanced and risky setup, but you can apply a higher risk-to-reward ratio. If you are lucky and trail your stop, you can catch some giant reversals. If you learned something new, please hit the like button and subscribe to stay up to date with our latest releases. And check out our Academy program if you want to further level up your trading. Until next time.